So the third or the last case that I will talk about today is a recently decided case by the Supreme Court, which was on June 4, 2014. So this is between the petitioner, the Hong Kong and Shanghai Banking Corporation, versus the respondent, Commissioner of Internal Revenue. So the facts of the case are as follows. HSBC performs custodial services on behalf of its investor clients with respect to their passive investments here in the Philippines. Particularly, these are shares of stocks in domestic corporations. So it serves as a collection or payment agent of dividends or other income derived. The investor clients of HSBC maintains a peso account or a foreign currency account managed by HSBC through instructions given through electronic messages. So these instructions are standard forms known as SWIFT or Society for Worldwide Interbank Financial Telecommunication. In purchasing shares of stocks and other investment securities, the clients would send these electronic messages from abroad instructing HSBC to debit their local or foreign currency accounts. So pursuant to these electronic messages of investor clients, HSBC purchased and paid documentary stamp tax in 1997. However, in 1999, a BIR ruling was issued by the BIR stating that instructions or advices from abroad and management of funds here in the Philippines which do not involve transfer of funds from abroad are not subject to documentary stamp. So with the said BIR ruling, HSBC filed an administrative claim for the refund of the amount of 19 million and another 32 million, representing the two erroneously paid documentary stamp tax for the BIR on the years 1997 and 1999. So its claims were not acted by the BIR. Thus, HSBC brought the matter to the Court of Tax Appeals to suspend the running of the 2-year prescriptive period. So the Court of Tax Appeals favored or ruled in favor of HSBC. However, the Court of Appeals reversed the decision of the Court of Tax Appeals, explaining that under Section 181 of the Tax Code, the DST or the documentary stamp tax is levied on the acceptance or payment of a bill of exchange purporting to be drawn in a foreign country but made here in the Philippines. So to reiterate, the issue in this case is that whether or not the electronic messages are considered a bill of exchange which a documentary stamp tax can be levied upon. So the court's ruling or the Supreme Court's ruling is this. No. The court favorably adopts the finding of the Court of Tax Appeal that the electronic messages are not negotiable instrument as they lack the feature of negotiability, which is the ability to be transferred, and that said electronic messages are mere memoranda of the transaction consisting of the actual debiting of the investor clients or payer local or foreign currency account in the Philippines and entered as such in the books of account of a local bank. So Section 1 of the Negotiable Instruments Law states that an instrument to be negotiable must conform to these requirements. First, or letter A, it must be in writing and signed by the maker or the drawer. B, it must contain an unconditional promise or order to pay a sum certain in money. C, it must be payable on demand or at a fixed or determinable future time. D, it must be payable to the order or to the bearer. And E, where the instrument is addressed to a drawee, he must be named otherwise indicated therein with reasonable certainty. The electronic messages are not signed by the investor clients as supposed drawers of a bill of exchange. They do not contain an unconditional order to pay a sum certain in money, as the payment is supposed to come from a specific fund or account of the investor clients, and they are not payable to the order or to bearer, but to a specifically designated third party. Thus, the electronic messages are not bills of exchange as decided by the Supreme Court in this case.